How Canadian mortgage borrowers are being ripped off compared to U.S. mortgage borrowers. Contrasting mortgage practices, exploring the disparity between 30-year fixed mortgages in the United States and 5-year fixed mortgages in Canada. In the realm of mortgage markets, two North American nations, the United States and Canada, stand apart with their distinctive mortgage practices. While the United States favors 30-year fixed mortgages, Canada predominantly embraces 5-year fixed mortgages. This intriguing discrepancy raises questions about the underlying economic, regulatory, and cultural factors influencing these divergent approaches. In this in-depth analysis, we delve into the nuances of mortgage practices, shedding light on the rationales behind the contrasting strategies employed by these two countries. The United States, renowned for its dynamism and entrepreneurial spirit, has long championed the 30-year fixed mortgage as a bedrock of its housing landscape. This enduring mortgage term traces its roots back to the early 20th century, where it emerged as a response to economic shifts and market uncertainties. At its core, the 30-year fixed mortgage provides stability and security for homeowners, affording them a consistent payment schedule and peace of mind over an extended period. While the 3-decade repayment timeline may initially appear daunting, it effectively facilitates affordable payments, making homeownership more attainable for a wide range of aspiring homeowners. The United States' sizable and diversified economy plays a pivotal role in supporting lenders' embrace of long-term mortgage commitments. Its robust financial infrastructure enables lenders to absorb the risks associated with extended loan durations, ensuring a stable supply of mortgage financing. The concept of mortgage-backed securities, MBS, has also greatly influenced the popularity of the 30-year fixed mortgage in the United States. Mortgage loans are pooled together, transformed into MBS, and traded in a thriving secondary market. This market mechanism offers liquidity and fosters investor confidence, providing a steady stream of funds for lenders to sustain mortgage lending operations. Additionally, the fixed nature of mortgage rates shields borrowers from volatile interest rate fluctuations, enabling them to plan their finances with greater certainty and stability. In contrast, Canada, known for its prudence and stability, predominantly favors 5-year fixed mortgages, underscoring the nation's commitment to risk management and adaptability. The prevalence of this mortgage term stems from Canada's unique financial tradition, which prioritizes mitigating potential risks and maintaining stability across its mortgage market. Canada's mortgage landscape is characterized by the dominance of the Big Six banks, including Royal Bank of Canada, Toronto-Dominion Bank, Bank of Nova Scotia, Bank of Montreal, Canadian Imperial Bank of Commerce, and National Bank. These financial giants adhere to a cautious approach, exemplifying a philosophy of prudent risk management. By offering primarily shorter mortgage terms, typically 5 years in duration, these lenders effectively mitigate the risk of rising interest rates. When a mortgage reaches maturity, it provides an opportunity for borrowers and lenders to reassess the prevailing interest rate environment and renegotiate the terms accordingly. This flexibility shields both parties from sudden economic downturns or unforeseen shocks, ensuring financial stability in the face of fluctuating interest rates. However, it seems that the banks are shielded more than the borrower. If interest rates have gone up at renewal time, the borrower will have no choice but to accept a higher interest rate, as the rates at all banks would have similarly increased. Moreover, Canada's regulatory framework plays a significant role in shaping its mortgage practices. The country's robust regulations are designed to maintain control and safeguard financial stability. Notably, stringent mortgage stress tests are implemented to assess borrowers' ability to withstand higher interest rates. These stress tests evaluate borrowers' capacity to handle mortgage payments at a higher rate, thereby reducing the risk of mortgage defaults and reinforcing financial stability within the Canadian housing market. While the United States and Canada employ divergent mortgage practices, each approach carries its merits and reflects the unique economic, regulatory, and cultural contexts of the respective nations. The 30-year fixed mortgage in the United States offers stability and long-term planning opportunities, providing homeowners with the confidence to chart their financial future. On the other hand, Canada's preference for 5-year fixed mortgages prioritizes adaptability and risk management, allowing borrowers and lenders to periodically adjust interest rates in response to changing economic circumstances. In conclusion, the contrasting mortgage practices between the United States and Canada highlight the multifaceted factors shaping these mortgage landscapes. Both nations share a common goal of fostering accessible housing opportunities, albeit through different approaches. Understanding these intricacies empowers individuals to navigate the mortgage market effectively, making informed decisions aligned with their unique financial aspirations and market conditions. Let's examine the practical workings of the mortgage systems in the United States and Canada, shedding light on the advantages and limitations of each approach. In Canada, where 5-year fixed-rate mortgages are prevalent, borrowers face the risk of higher interest costs when their mortgage term expires and they need to renew the mortgage. If interest rates have risen significantly during the 5-year term, borrowers may encounter challenges in securing a new mortgage at a similarly favorable rate. This situation can lead to increased monthly mortgage payments and potentially higher overall interest costs. For some borrowers, particularly those with tight budgets or limited financial flexibility, this could indeed be financially burdensome. On the other hand, in the United States, where 30-year fixed-rate mortgages are commonly utilized, borrowers enjoy the benefit of having their interest rates locked in for the entire mortgage term. This feature provides stability and protects borrowers from rising interest rates during the 30-year period. As a result, U.S. borrowers have the advantage of knowing their mortgage payments will remain consistent over the long term, regardless of any fluctuations in the broader interest rate environment. Furthermore, U.S. borrowers have the option to refinance their mortgages if interest rates decrease significantly during the 30-year term. Refinancing allows borrowers to replace their existing mortgage with a new one at a lower interest rate, potentially resulting in reduced monthly payments and overall interest costs. This flexibility can provide significant financial relief, enabling borrowers to take advantage of market conditions and potentially save money over the life of their loan. The process of refinancing in the United States involves applying for a new mortgage, typically with a lower interest rate, and using the funds from the new mortgage to pay off the existing one. Refinancing can be particularly advantageous when there is a substantial decrease in interest rates, as it allows borrowers to benefit from the lower rates and potentially reduce their monthly mortgage payments or shorten the loan term. It is worth noting that refinancing in the United States comes with associated costs, such as closing costs and fees, which borrowers need to consider when assessing the potential benefits. However, for many borrowers, the savings gained from refinancing can outweigh these costs, especially in a low-interest rate environment. In summary, Canadian borrowers with 5-year fixed-rate mortgages face the risk of higher interest costs if rates increase significantly when it comes time to renew their mortgages. This situation can pose financial challenges and potentially lead to higher monthly payments. In contrast, U.S. borrowers with 30-year fixed-rate mortgages benefit from having their interest rates locked in for the long term, providing stability and protection against rising rates. Moreover, the option to refinance in the U.S. offers borrowers the potential to lower their interest payments if rates decrease during the mortgage term. Objectively looking at both systems, it is obvious that relative to the U.S. system, Canadians are getting ripped off. This might possibly be due to limited competition in the Canadian banking industry, as there are only 6 national or big banks in Canada compared to the U.S., where there are many more big banks. Canadians are being forced to face greater risk of increased rates every 5 years, and they are also locked into high rates if those rates drop during the term of the mortgage. Let me know in the comments what you think. Would you like to be able to get an U.S.-style mortgage and lock in your rate for 30 years, and then renegotiate the rate down if market interest rates drop substantially? If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.